correction at the aftermath of the bazooka 75 basis points that the Fed went forward with in rate hikes, and some others followed. The Swiss surprised everybody with a 50 basis points. All the currencies pegged to the dollar here in the Middle East also went 75 basis points. And it looked like it obviously gave oil prices a jolt off its comfortable 120 spot where it sat for some while now. Let's kick off this morning with Christoph Ruhl, Senior Fellow at the Columbia Center of Energy. Christoph, your thoughts on the week in review, what stands out from you? Obviously, the points I just made in reference to the move by the Fed, and has this finally shifted oil into a downward motion?
Probably. So I'm tending more towards people who've been to be bearish in the third quarter. What we have seen there with oil is, as you said, it's the recession fears and the decline in demand from China, and it's also the upcoming Biden visit and the realization that we are pumping already 1 million every day from the Strategic Petroleum Reserve, that there will be more from the Saudis and the UAE forthcoming if they want to continue business with Russia. There will be a deal. We are seeing Venezuelan oil showing up and being signed off to be sold to Europe and all that. So, that market is not as tight as everybody always says. And I'm talking about the crude oil market. It's different from products, of course. But lower crude oil prices with an elastic global refining system will eventually feed through also to product prices. So this is within the realm of normal, and I would not include it really. If I would have to pick last week's events, and I try to be brief. So starting at basics, there is something interesting going on in the actual theater in the war between Russia and the Ukraine. Seems to be completely stale and not that much moving, and the Russians outgunning the Ukrainian, but not having the people to actually storm position. But when you read, as I do now, these military people who should know better, what they observe is that it actually turns gradually in the favor of Ukraine, seems to be. The Russian forces are pretty much spent and depleted and highly concentrated on the small area in the Donbas, which these analysts say, from a military perspective, is fairly insignificant. And we should wait for counteroffensives by the Ukraine in the north and in the south, in a bigger cauldron, which would encapsulate the Donbas. And what happens there, militarily speaking, whether they capture this city or not, or in a week or in two, is not all that important. I tend to believe that because it is built on the argument that more weapons are coming, and you can tell, Zelensky is now suddenly visiting the front lines. The visit of the three people into Kiev came for sure with promises, and Putin sounded pretty desperate, and what he does in gas markets is pretty desperate on the other side. So there is movement forthcoming. Secondly, the economics, there's everybody, of course, talking about inflation and the Fed, but I'd just like to remind all of us that at the end of the day, of course, it's true, high energy prices feed in everything and they fire up inflation if they're rising. But energy at the end of the day is not sort of the general price level. It's one relative price. And if it goes up and then feeds through, then it's gone. If it goes down with equal speed, it will have a relaxation on the general price level. And that's why central banks exclude energy and food usually from their inflation gauges. The danger with inflation is that we get people's expectations delodged, and then they say we want higher wages, we want charge higher prices, and you have the spiral developing. That's what the Fed and the others are trying to address by this big guns now. And the risk here, obviously, is that just as they were sleepy when inflation picked up, that they may overshoot now and kill the economy by being too aggressive. The jury on that is still out, but that I think is at the moment the bigger danger. The good news is that maybe stock markets sort of start to even like that, get used to it, and say, okay, we deal with this problem swiftly and once for all, and then life goes on, as you said last time, a small recession. And then let me conclude with what I think is a significant move that's in gas markets. Of course, the Russians now curtailing gas deliveries to Europe. Europe, a little bit like the frog in the hot glass, sitting there not knowing what to do. This is interesting to me because it relates to something close to my heart. We had these discussions before. How do you organize sanctions? How do you design them? The European Union in oil has done what they always do, and based on this principle of unanimity, have agreed on the lowest common denominator. You know, sanctioning oil which is on ship. This is the one which is the easiest replaceable. Not sanctioning the one which is in pipelines, which they could have just dry up, and then you Hungarians could have protested until for a long time without a success. But in gas, it's different. In gas, it actually continues to be horses for courses in a completely decentralized and voluntary way. We have now 4 countries, Poland, Bulgaria, Netherlands, and Lithuania, I think, which have said we're not going to go even in this kind of construct of how to pay in rubles. We're not doing that, and which have been cut off by Gazprom. So that takes away between 16 and 20% of the European deliveries already. And now we have Gazprom sort of retaliating and trying to increase the heat a little bit. And I think that has all the promises if the European Union is not too stupid and maintains this flexibility, and now, for example, starts replacing it by coal now, not when it's too late, that we will see some gas being shut in Russia, which cannot be sold anywhere else, and which will have more tangible financial consequences than what we see in oil markets. And
yeah, let's give Adi a chance to come in on some of these points. Adi, your takeaway from last week, I was going to reference the decision on Russia on the gas side as being quite a significant sort of shift a little bit. But structurally, my question to you, Adi, is, you know, oil markets, the good old-fashioned sort of indicator of economic growth and the outlook of economic growth, oil prices have risen and fallen on that little thing for decades now. And I'm wondering, with this development, your thoughts on the inflation and the Fed, that we're now back to fundamentals. Forget about the war and all the other noise, that this is now moving back to a fundamentals growth story. Your thoughts?
Yes, thank you very much. It's quite a lot to unpack there, but I'd agree that last week the key development was the macro situation and the rise in interest rates. Of course, I would say that it's somewhat a spurious correlation, obviously, because first of all, I don't think the inflation is a result of OPEC policies and high oil prices. The inflation is a result of the policies that were done a year ago, i.e. the massive stimulus over a year ago, massive stimulus in the economy, and as a result of which we had a massive bounce back in terms of oil demand. That's why the products are being hit first rather than crude oil. So that's number one. The other point I'd like to make is that I agree with Christoph in terms of inflation, that the definition of inflation is persistent increase in the general price level. So an increase in oil prices one-off is not going to cause you much of inflation. It will contribute to rise in prices. So what we are dealing here is basically dealing with the Fed, dealing with the expectations, and in the process, basically bursting the bubble. You can see it best in sort of Bitcoin and the likes, high risk corporate bond yields and so on. So I think the point to take here is that the higher interest rates, and these are quite a bit higher, 0.75 is a lot, and it probably has quite a bit to go as well. This is the important thing. When you have inflation of 10 and your current rates are 1.5 to 1.75, you're way off of your real rates being positive. But of course, you are, I agree, Christoph, that you're trying to kill the expectations, and in the process, you don't have to go with interest rates all the way up. What happens with the commodities in general, commodities, as we know, sort of one-on-one commodities, is they don't yield anything. If you're long commodity, you actually only have cost, primarily storage cost, insurance cost. So what you're counting on is the capital gains. And of course, in the current environment, you cannot count on that because we are expecting there's a very high risk of recession in the United States by the end of the year, very high risk. And I think that certainly doesn't bode well for sort of high risk, highly leveraged stock and highly leveraged assets. And oil very often falls into that. So any speculative buying or being long oil is going out of the window. So I think that's all very, very important. And the macro picture is absolutely key here to understand that the fall in the oil price. But oil price, at the end of the day, the fall is fundamental. It's fundamental because we are in a very similar situation as in early 80s, 79, very high oil prices, big oil shock, OPEC cutting more, reluctant to supply more into the market, which killed demand. About 4 million barrels plus were killed in early 80s. And then we had mid 80s and complete collapse in oil prices. And I think OPEC has a fair share of blame for that. I think Saudi's UAE could have supplied more oil and could still do that to avert, and I'm sure we'll come to that point in a minute, could still avert recession in the Western world. Additional 1 or 2 million barrels would go a long way to help the current reasonably tight market.
It certainly, I think, has to be on the agenda for the Biden visit as to what their role is in managing, maybe not avoiding the recession that's coming, but maybe the journey out of it, or how long it will be, because that idea that energy prices, Christoph, could stay high through this downward economic cycle. And just speak to the point, Christoph, because you mentioned in your earlier point, of course, the idea of where supply is coming from and additional supply. But most notably, I would say, out of last week was the data from Russia. They're exporting even more crude oil than they were a month ago. I mean, that seems to be the most unlikely source of additional supply. Your thoughts on that?
I think they're still down in crude oil. They put some more on ships to Europe, but I think they're still down over the year. But it's marginal. You're right. So we shouldn't forget that the war is still there, and we can't just exclude it. The big picture is, as we just discussed, one decline in demand because of potential for recession, increase in supply because the Saudis and the UAE and Iran and others being pushed into producing more. That's fairly simple. But then what the Biden administration wants, of course, is a redirection of oil flow. So they want more oil from the Middle East into Europe, and then they want to sort of slowly throttling of the Russian supplies, first by Europe not buying it anymore, and then presumably by Asia, by hook or crook, either voluntarily or forced by secondary sanctions, joining the sanction system. That's going to be very interesting whether that actually happens, and I'm quite skeptical here. But what matters is that already there's two things which are important by taking the war into account of this big demand and supply picture. One is that the countries which are not sanctioning Russia have a distinct advantage now. Not only do they get Russian oil, they get oil 35 to 40% now lower than the Europeans. So Chinese businesses, in terms of oil and also to some extent gas costs, are sort of outcompeting European business on a large scale. And it's not clear that they will be lining up to give up this advantage. And secondly, they are actually more sensitive because they're more oil intensive than the European Union or the US, and oil demand is still growing in India and China. So they're much more sensitive to what happens to the oil price. And this seems to sort of now go into some coalition course, even if Biden succeeds for obvious reasons to get more production out of the Middle East and into Europe. Even if the Europeans go ahead and continuously sort of cut off themselves from Russian oil supplies, it's far from clear to me that Asia will actually sort of acquiesce and say, okay, fine, we like sanctions, we like high prices. That's very far from clear, and that causes problems down the road between mostly China and the US.
Yeah, it doesn't seem like the opposite from our commentators out of Asia, China, that they expect the percentage of Russian oil as a percent of their total imports to maybe grow up to 30% this year, and maybe in as high as 50% next year. Adi, I wanted to get your thoughts on the phrase that was used again last week by the Fed. We will do what it takes to get down to 2%. That was a major rallying cry for the markets on the upside. We'll do what it takes to keep this world afloat in liquidity. And all the traders bet the house on that and made a fortune. I'm wondering, if you were still sitting at the trading desk, how do you bet on this new phrase on the downside in terms of the Fed? We're going to do what it takes to take inflation down to 2%, because that's quite a massive statement given the challenge that they're facing.
It is a massive statement, and I think it comes from the fact the central bank completely missed the plot. originally. They never ever expected anything like this. So it's a kind of self-guilt, but there's also pressure from the Biden administration and the US population in general, because as we know, the high inflation usually tends to hit the sort of middle classes and the poor. So it's very important, hugely important. But I think that's the primary role of that expression was to try to kill in the bud the inflationary expectations, which early on Christoph mentioned, I think are the key. Because there is a.
I mean, it strikes me that trains left the station. I mean, that's wishful thinking. If you could still jawbone the inflation downward.
Well, there's no choice. I think inflation expectations, we all know in economic theory are absolutely key to further development in inflation. They have no choice but to actually A, say that, and B, they'll have to act on that. And that's why the market reacted. They will have to act on that. I think the next increase, all things equal now, will probably be exactly the same, 0.75. How on earth do you get to 10%, 9%, whatever inflation is expected to be, if you only got 1.5% a nominal rate? You know,
Christoph,
that's a long way to go.
On that point, just from a point of view of obviously we articulate that energy is one component of the inflation upward motion of all prices in production. And on that point, given that we are only 100 days into like having shifted from $80 to $120, that, you know, most of that feed through of that extra $40 in the energy oil price has yet to really feed through the system of production in terms of cars and everything else that energy would be used. I'm just wondering that lag, that leap. So my point is that inflation has still got an upward journey to make in order to facilitate that energy rise from the war months. Your thoughts on that?
No, there's not a big lag for energy or for oil prices in particular. First, what Fed has said, that's a quote, right? They're quoting Draghi in 2012 when he was trying to save the Eurozone. And it goes almost in the category of despair or famous last words, because this is what central banks do normally only when they have the back to the wall and they want to prevent a run or something on their banks. Lamont in the UK, you may remember, did that in, I think, 1900 or 92 or something. Before the pound collapsed, and so this will never happen. So that's, as Adi said, a clear appeal to expectations in the markets, sort of to not anchor inflationary expectations and to believe that it goes away. To your question, the saying is always there are long and variable lags. Nobody knows exactly how long, but again, the danger for inflationary pressure comes from people increasing their prices where they can, where they have pricing power, and then their wages. An increase in oil, in particular, is a one-off cost, which, as you are right, will go into the price of shoes and everything else, but to a marginal extent increases transport prices by a lot, increases whatever shoe prices probably by very little. And again, the economies which have the inflation problem, most obviously the US and the Europeans, have a much lower oil intensity than China or other economies. So they're much less subject to the real inflationary impact of an increase in the oil price, because oil is less important in their input mix for what they're producing. And so I think that also when it comes to sanctions, the Americans probably know that. And we shouldn't lose the eyes, we shouldn't take the eyes off the ball. The purpose of the sanctions was not, to deal with inflation. The purpose was to get Russia out of the Ukraine. The only way to do that is to make them really suffer financially. And one of the ways to do that is to bring prices for oil down, including especially, of course, for Russian exports, and volumes down and clog up the system. And this is why we will see these attempts continuing even more so if the general environment is one decelerating oil prices.
Let's go to the survey question on this subject. And it's again, have elevated crude oil prices met their kryptonite with the do it what it takes Fed to get inflation down to 2%, i.e. essentially choosing recession over inflation and with less growth and declining, contracting growth, demand for energy falls. At least that's the basic principle of economics. So I'm not sure we're in that era anymore, but nonetheless, let's have a thought on that. Adi, looking forward, week ahead, some thoughts on I mean, Christoph made an interesting insight there vis-a-vis the war, and I have to say I'm by far any kind of military expert. My sort of general headline sense was kind of the opposite, that the Russians were consolidating gains and were facing a choice now of moving to Odessa and into Moldova. We did see last week another big story that the EU not only acknowledged the acceptance of the pathway of Ukraine to come into the EU, but also Moldova. And I think the signal there is, don't, the idea the Russians may look to, obviously they already have troops on the ground in Moldova. Your thoughts on where we're going next vis-a-vis the European position with the war, the commitment, the engagement?
I think Europe, whatever the apparent discord within European countries is, and let me just go back to an earlier point, these cuts in gas supplies to Europe by Russia. Well, originally they were a threat. Now Russians have the import ban on Russian crude in place, and that's where they get most of the money. So that really hurt Russia a lot. So gas as a threat has gone. Is basically, well, the ban is there for crude oil. So what is Russia going to do with gas supplies now? I think they're trying to cause more discord.
I mean, the
European
headline
countries.
on that seems to be, and you can correct me, Adi, is that forcing the Europeans to use their stored gas now instead of hoarding it for next winter, which is what they're trying to do. By depleting supply now over the summer, they'll force the Europeans to consume what they're putting in the bank for next winter.
Oh, absolutely. I mean, the Russians are clearly using gas as a weapon. We saw that prior to the Ukrainian invasion, that there were cuts in supplies. We were all wondering what's going on, but actually, Gazprom was trying not to fill in the storage for the winter. We missed a lot of these telltales. Well over 2 years ago, I think it's close to 3 years ago, Russia deployed a LNG storage vessel, Marshal Vasilevsky, at Kaliningrad, which is the enclave in the Baltics. So basically, they already knew that they were going to use gas as a weapon, and they were trying to protect their own enclave with supplies. So they're definitely making all these steps forward. Now, Europe, because of the nature of European Union, obviously cannot act as well as Russia with Putin, one man out there. And it looks like there's a lot of discord, but I don't think so. I actually personally think that Europe has never been more determined and never been stronger in their opposition to Russia. And I think the key to the European position versus Russia has been the U-turn in Germany. I think that's extremely significant. And economically, Russia has no chance. This is economic warfare at the moment, and I hope it stays that way. But in terms of economic warfare, Russia is a dwarf compared to Europe. And I don't think, even though there are an energy superpower, but I think at the end of the day that Europe will prevail in this economic warfare. As far as the situation in Ukraine, I'm not sure, but I don't think that Putin is done. I think that he will do everything he can militarily within Ukraine that he can get away with, because he's already a pariah, so he's got nothing to lose. What worries me further on, I think, and this is why I slightly disagree with Christoph about the stalemate situation, I think in areas that he doesn't have direct military involvement, he will try and keep all those other areas in Europe destabilized. So we'll see more and more instability. As long as Putin is in power, we'll see more and more instability in Europe, I'm afraid.
Christoph, just picking up on that outlook from the point of view of Europe's ability, its strength, of course, the West. Now with interest rates rising, we've got the German finance minister, Christian Lindner, over the weekend saying that servicing Germany's public debt next year could reach 30 billion euros because of interest rate rises, which of course is relevant relative to their wealth and power. But it tells you obviously the wider story. Every company is going to have to pay more interest rates. Every individual is going to have to pay more debt. Like this impact, this follow through of higher rates on the spending power of sovereigns and corporates and individuals. How's that the outlook for that to filter through, do you think, on energy demand?
Well, this is why it is so important to get rid of inflation decisively and fast, because what you don't want is a long period of stagnation coming out of this because of higher interest rates. But on the other hand, I mean, welcome to the real world. The abnormality was the last 10 to 15 years with below zero negative interest rates. That was not healthy and led to a lot of misallocation. The best example is just crypto. That's completely, utterly useless stuff. Always has been. Millions of people have said it all the time. Now, finally, it falls back to a price which is associated with utterly useless stuff. And for years, it was sort of hyped up to, as a replacement for money. And so these are somebody wrote, even the tulip mania in the 18th century. The tulips you can eat if necessary. I can look at them. So crypto you can't do anything with. And so these kind of things to be cleaned out is not necessarily a bad thing. In the bigger theme of things, and it's important to keep the war perspectives. It's interesting, in German newspapers, they have now taken to sort of daily reporting of the storage, how full it is in gas. And it's actually bang on the historical average, 50-some% right now. It's far above the lowest times we have seen over the last 5 years. So bang on the average. And if they switch now into coal, which of course the Greens don't like, then they could probably continue to fill it over the winter. And as far as Russia is concerned, there's one thing I would encourage everybody to read in this weekend's, must be yesterday or today, this weekend's Financial Times, an interview with Mikhail Khodorkovsky, who is the ex-boss of Yukos, an oil man, so we should all find him interesting, who turned against Putin, spent 10 years in jail, and is now sort of a sharp commentator. And he's right in what he says. It's not only as Western observers have observed that Putin thinks he dies if he loses, but he probably does think that. It is that most likely this conflict, if it is continuous, will be the end of that Putin, will be the demise of this regime. We don't know if we're replaced with something better or more ugly, but it will not remain frozen and static all along. And he coined this expression of the Russian population suffering from the Stockholm syndrome, which is when hostages try to sympathize with their hostage taker. And I think that's quite accurate. But when I look at the economic figures right now, Russia's economy performs a lot better than the Ukrainian economy. Tend to forget there's an economy, it's not just war. Better in inflation terms, better in exchange rate rules and so on. But this is changing and this is going to crumble. And if these energy sanctions are maintained, including the discount to Asia, 30-40% less in a falling oil price environment, then it will not be enough to sort of make Russia give up on something, but it will cause serious problems internally.
Let's give the last word to Adi and get the survey result before we post it for further voting on social media. The survey result on the outlook for oil prices hasn't met its nemesis in terms of the higher interest rate environment. And there's a confident, at least, room here that says no. Higher rates are not the kryptonite. Adi, the reality of declining economic outlook and its weight on the oil price, we're seeing now reporting on freight rates that container spot rates are now falling below the long-term contract rates, which means that contractors are going to look to renegotiate with ship owners on their long-term contract deals because their container spot rates are much further below, are moving below the long-term rates, which in itself is another indicator that the outlook is weak. Your thoughts looking forward on how this sort of macro picture squeezes oil prices lower in the coming week or not?
Well, I think macro picture is the key at the moment. I think most of the other stuff are already taken into account in prices, and some of the moves like Biden's visit to Saudi Arabia are probably discounted. I don't think we can expect too much result out of it. We haven't spoken about it much, but let's leave it for now, maybe next time. Macro picture is the key at the moment in terms of the pull. It's not so much the interest rate, even though high interest rates, as I said, are not very good for commodities. It's actually spurious correlation. It's actually the threat of recession resulting from those rates that will lead to lower oil prices. I'm quite worried because I don't think the Fed is still believing in a sort of Goldilocks move down that curve, inflationary expectations curve, and economic growth remaining positive. That is 1 in 100. If they can hit it, it's a possibility, but it's very unlikely. I think that the chance of recession is much higher. And the other problem with higher rates and doing whatever it takes is the debt problem, which we briefly mentioned in our discussion. All the governments are actually, they've thrown kitchen sink out of the window to make sure that things work and that the COVID situation does not harm the economy. Right now, it's all coming to roost with massive debt, not just primarily government debt that they'll have to deal with. And I think there's a danger, and a lot of them see that danger, that the governments don't quite, if you look at the Bank of Japan, what they're doing, don't quite go all the way because they're worried about their debt. And
well,
Japan
we're seeing in the UK, they're only a tepid
Absolutely.
25 basis points. And
Yes.
now you're going into a week with, I think, the biggest transport strike in 40 years or something like that.
Absolutely. We've got 3 days of strikes, Tuesday, Thursday, Saturday. We are literally, it feels, I'm old enough to, okay, I was quite young, but very young, but it feels like 70s, very much so. The government role in energy sector, the government role pretty much in anything, government role in sort of industrial policy, and now we've got a much bigger role of all the trade unions that are trying to protect the interest of their own members. So, and that's what is going to lead to a further inflationary spiral if the government agrees to these demands. And I think I'm not very optimistic, and then we'll have further disruptions. So it does feel a little bit like the 70s. It's very bumpy. I don't want to be too negative about it, but I think that.
But I think the UK is kind of at the extreme end of this narrative in its variety of pieces in the puzzle.
It probably is, but on some respects, it's actually in a better situation than Europe, because on the gas side of things, I'd much rather be in the UK than in the Europe, about worrying about the heating for the next winter, for example. So, we are going through a very difficult period, and it's not just Europe. We're talking too much about Europe. I think the biggest impact at the end of the day is going to be on the developing world, Africa, Southeast Asia, the Bangladeshis, Pakistanis these days.
Well, if you didn't think you had it bad, you could be put on a flight to Rwanda as you thought you were going to go have a pint in Islington, and next thing you're being shipped off. I mean, it's rather absurd what's happening in the UK at the moment, and rather sad for a country that has always embraced immigrants.
Well, it's a government. It's a government that's struggling. It's a prime minister and the government that are really struggling to stay in power, and you can expect a lot of volatility out of that. But in terms of the economy, I think UK is doing as well as anyone else. So I wouldn't worry too much about it.
Well, we have to leave it there. Christoph disagrees completely with that. And I think I would be shaking my head as well with Christoph. The UK is scoring so many own goals, it seems to me, never mind in the north of Ireland, and trying to undo the protocol there. And it's too much to talk about. But thank you so much, Adi Sirovic. Thank you very much. Have a great week. Great to see you both. Christoph Ruhl with your beautiful dozen roses in the background there. It must be a special occasion. Or it's just another Sunday in the Christoph Ruhl house. Thank you so much, and we'll catch up in the coming days, 10:30 UAE time. All the best.